This next conversation is going to be about investing in Africa and how to spur investment across the continent, which is home to many of the world's low-income countries and a number of countries that are also facing the type of sort of volatility or fragility that we talked about earlier today. And to have this conversation, I want to welcome on our stage Alexia Alexandropoulou, who's the research manager at the African Private Equity and Venture Capital Association, Kapil Kanungo, who's the private equity and fund development manager at Incofin. And joining us virtually, we have Teddy Onserio, who is the East Africa Investment Advisor for the U.S. Development Finance Corporation, and Paul Horrocks, the head of the Private Sector for Sustainable Development Unit at the OECD. And I believe we also have Travis Adkins, though I don't see him on the screen. I don't know if but hopefully he's also with us. And Travis is the president and CEO of of USADF, which is the U.S. Africa Development Foundation. So to kick us off, I'm actually going to turn to Alexia first, because you're the research manager, which means you can probably paint us a pretty good picture of what the sort of market looks like today, where we've seen growth, and what sort of capital flows look like.
Sure. So I would like to start by giving you some information on how Africa's private capital market has evolved in recent years and what are the main trends that are driving the growth of the industry at the moment. So the dominant trend has been the tremendous growth of Africa's venture capital industry. Venture capital in Africa has evolved gradually into a very well-known and recognized investment theme that has attracted international investment to the continent and has also encouraged the development of many homegrown financing solutions. We published a study in March 2022, and according to our data, 40% of all the investors that participated in VC deals in Africa came from North America. So it's indicative, this indicates the growing interest from investors all over the world for Africa's entrepreneurial space. Also, the venture capital industry has not attracted international investment and has encouraged many local venture capital firms, but has also encouraged many investors that were previously focused on private equity or private debt infrastructure to change completely their strategy and include VC into their current strategy. So VC, the dominant trend. The second thing that I would like to mention is the role of the technology and the growing appetite of investors for opportunities within the technology sector. The technology sector has disrupted and transformed the development of many other industries: agribusiness, healthcare, financials. We published our half-year data a couple of weeks ago, and we found that over approximately 80% of all the investments that were recorded in Africa during the first half of the year were in technology or technology-enabled companies. So the technology theme is driving Africa's growth for sure, and is attracting a lot of attention from investors from all over the world, especially fintech investments in financial technology. So the third theme is the contribution of infrastructure investments to the development of Africa's private capital industry. We have seen many investments happening in renewable energy projects, in transportation, data centers. So this is a trend that is here, and it will continue in the years to come because a lot of funds closed recently, and these funds were focused on these sectors. And finally, impact investing. has been featured more prominently, especially after COVID-19. Although ESG and impact in Africa is within the DNA of investors because of the early involvement of DFIs in the development of Africa's private capital industry, this trend is even more prominent now, and there is a lot of interest in gender lens investing and climate investing from fund managers. In terms of where the market stands at the moment, considering the challenging macroeconomic environment, I would say that Africa's private capital industry managed to perform the market was very resilient and strong. We published our half-year numbers a couple of weeks ago, and the first half of the year was one of the strongest the continent has seen today, and other markets were suffering at the same time. So other emerging markets or developed markets, the investment activity there was much lower than in Africa. But Africa's activity was driven by early stage investments and by the fact that there was a lot of unspent capital during COVID-19, so a lot of dry powder for investors.
Great. Well, I think that's a really good sort of landscape, and it's kind of an interesting perspective because what you're saying is that so far, despite the volatility we've seen in the first half of the year, still there's sort of robust appetite and interest. I think one question perhaps we can explore is whether that will continue as we continue to see some of these sort of macroeconomic conditions and whether we will see sort of some capital flight, especially with interest rates and sort of what that means for some actors in the development finance space, because capital might be harder to get from commercial markets and then sort of much more needed. Kapil, I want to go to you. You guys have funds, you're deploying capital into Africa. So tell me a little bit about sort of how you see the market, what some of the challenges that you're seeing are, and sort of how you're able to successfully deploy this finance.
Sure. But perhaps I just want to quickly take the thread from Alexia about resilience. So I think one of the things, I want to go back maybe just a couple of years. I remember when we were all reading those news reports coming out when the first time COVID broke on the scene. And they were painting an absolutely catastrophic picture of what could come in Africa. At this point, thankfully, we have benefit of hindsight and we can see what has happened. And what I see is at least, a path-breaking story of resilience. Now, why am I talking about that in the context of investments? Because that's exactly what we have seen in our investments as well. So throughout COVID-19, we've had zero restructuring or workout cases on our financial inclusion debt portfolio in the region. So it tells you how resilient the entrepreneurs are, how resilient the economies are in many ways. So it's true that the economies are facing their own challenges. But that said, there are high quality entrepreneurs in Africa at this point who are trying to build businesses that are extremely good. So that's one. The second one, and before I move on to the challenges, the second interesting thing that we are seeing, especially on some of the agri work that we're doing in the region, is that I think Africa presents at this point a once in a lifetime opportunity for investors to help create sources of value creation on the continent. So to give you an example, we invest in cashew nut value chains in Burkina Faso. Now, in Ivory Coast. Now, in that country, you see, Ivory Coast produces almost 1 million tons of cashew nuts a year. So it's number one producer of cashew nuts. 90% of that is exported. It's exported in raw form to traders who then take it to India or Vietnam, where it's processed, and then it's sold to markets in Europe and US. Less than 10% is processed in-house. So what we're trying to do now with smallholder organizations or SMEs is that we're trying to give them long-term finance along with technical assistance to make sure that a lot of that processing can happen locally. Now, once that happens locally, it's a win-win. It's a win for us, it's a win for them, because the value creation then does not have to move out of the continent. It happens in the continent. And as investors, that's great for us, both from a debt side as well as from an equity side. In terms of challenges, I think there are several challenges. The biggest of them all is political risk. You look at any report that comes out on, and maybe just before that, let me preface my statement, which is, look, Africa is a large continent, 1.2 billion people, 54 countries. So, I mean, what we're trying to do here is make gross generalizations about a continent. So a lot of what I'm going to say might resonate for, say, one country, but might not resonate with another country. That said, overall, if you look at risk indicators or country risk indicators that come out from any of the research houses, you'll see that African countries are often on top of the high-risk countries. But does that mean that those countries do not have high-quality entrepreneurs in them? The answer is no. So look at Burkina Faso, for example, where we have investments. Now, Burkina Faso has gone under 2 coups in the last 1 year. So does that mean that we should not invest in the country anymore? We think not. I think it's about managing those risks, mitigating those risks. Mm-hmm. And throughout all this time, I mean, since we've started investing in Burkina Faso, we've had 0 restructuring, 0 workouts. So it's about backing those high quality entrepreneurs, in my opinion. So I think that's number one. Political risk is a big one. The second big one, in my opinion, is we need the right sort of analytical tools to assess the businesses in Africa. So like a Series A in Africa looks very different from what a Series A looks in Asia. Just completely different markets. So if you don't have tailor-made tools for the region, and that's why it's super important to have people who are on the ground, who understand the realities, who analyze the business that should be analyzed the way it should be analyzed for that specific region. So that's very important. So I don't think we're using that well. And the third challenge, in my mind, is about using the right kind of financial instrument. So I think oftentimes what ends up happening is there's no cash flow-based lending that people would or that investors would make in African region. But that's key. If you want to lend to smallholder farmers, or if you want to lend to small and medium enterprises, they're not going to have collateral. So you need to do cash flow-based lending. Or there's this big missing middle now on growth capital. So larger institutional investors want to do larger tickets. There's some activity which is also happening in the venture capital space, but that whole growth capital is missing at this point. And growth capital in Africa, again, looks a little more long-term. So your classic, I'm going to invest, take my money out in 5 years, does not look as realistic in terms of returns for Africa. So can you tailor your financial instruments for the local needs? So I would say those are the 3 challenges.
Great. Teddy, I want to come to you next. And I'm curious, because you were talking about this sort of missing growth capital piece. And I wonder if that's, if DFIs have a role to play in that sort of part of the market. So Teddy, I'm going to throw that question to you and just get your sense of sort of how DFC sort of sees the market, what you're looking at in terms of the investments you're looking to make, what sort of role you see yourself as playing in the sort of ecosystem of investments.
Yeah, thank you very much. And indeed, I think that DFIs have a critical role to play as far as supporting businesses that have shown some potential to grow further. What I think sometimes is lacking is that there is a disconnect between maybe what criteria the early stage investors have invested in and how that flows into the criteria that a DFI, for example, is looking for. You've seen lately that several DFIs have actually launched programs where they're investing in earlier stage businesses so that they can also grow some of their pipeline opportunities in that regard. But the question remains, should each investor play in each sphere, or should we have a separation of sort of investment roles where there's people who are actually providing technical assistance, then there's people actually who are providing maybe feasibility study capital, and then there's people who are doing early stage investing, and then and so on and so forth, or should we try and do everything in that chain? I believe that given the size of DFIs and given that and the capital available to us and also the cost of that capital, we have a critical role to play in that growth phase. Also because the returns are a bit lower, and also because we can afford to sort of play in that particular sphere. But still, I think there could be better sort of coordination and collaboration between the different stages of investment between the different funders.
Great. Paul, I want to go to you. And one of the things that you spend a lot of time thinking about at OECD is the role of blended finance. Because one thing that I think we can talk about a little bit more is what is the role of first loss capital? And when do you need it to unlock that sort of commercial capital layer in investments or in funds across the continent. So I'll turn it to you and tell us a little bit about what we're seeing in terms of the use of blended finance. Where are we seeing it? How could it potentially be more effective? Because I think one thing that's key is that it's sort of used in the right ways, so you're not sort of undercutting the commercial case or creating a structure that distorts markets.
Yeah, thanks for the invitation to Devex and for facilitating this panel. I mean, blended finance is essentially about mobilizing additional finance to development. So what we want to see is the use of concessional and non-concessional finance put to that use. So DFIs have this mix. I mean, we have heard that there's sometimes the case of crowding out as opposed to crowding in. We've heard that there's a need for more first loss, and that there should be less pari passu requests from DFIs and NDFIs. So somebody's got to take the risk when you're sort of moving economies towards net zero, towards the SDGs, and maybe the risk calibration is not quite where it should be. And as we sort of seen with COVID, with the conflict in Ukraine, with the financial situation that we're going in OECD countries, but also potentially the sort of food crisis in sub-Saharan Africa, and the ongoing climate needs, that there's going to have to be more risk and more use of blended finance in order to mobilize the private sector. It's great to hear that the private sector seems still committed and that the deal volume is going up. I mean, we have seen 90 million more people thrown into poverty. So in terms of the social sectors, some of that VC funding will help sort of address, I think, the needs of the SDGs. But there needs to be a bit more thinking, a bit about mobilization. And we heard Janet Yellen talking about mobilization targets. We've seen that there's lots of funds and facilities being set up towards helping mobilize the private sector, but more essentially does need to be done. And we see certain sectors like climate where there's almost a sort of frantic ambition to get the deals, and sometimes probably coming in somewhat too concessional. So there's a variety of issues that I think need to be developed, and the private sector needs to be brought in at scale. We've seen some interest in terms of the other part of the capital structure that could help Africa is around green, social and sustainable bonds. And I think they complement these other parts of the venture capital and other private equity in terms of providing stable long-term funding, and with being able to mobilize at scale and being able to have impact. I mean, as we don't have too many ways to access deep pools of institutional capital in Africa, these are, I think, relatively neat blended finance instruments. So I'll stop there, and thanks for the question.
Great. So maybe let's talk about some of the sort of ways that more capital can be, well, I suppose, one, mobilized, but how do we bring more capital into the region? How do you increase capital flows? What types of investments need to happen? What type of de-risking instruments do you need to have in some of the higher risk markets? And like you said, it's a very diverse set of markets that each have really sort of particular nuances and strengths and challenges. And I think that in some ways, especially some of these countries are very small markets, right? So that makes it more difficult. So how do we look at some of the regional things or the Africa Continental Free Trade agreement and whether that can help to move things along? And so, Kapil, maybe I'll come to you. Maybe you can tell us a little bit about when you've had to use subsidy. When do you need to have first loss? How can that be used effectively? Because as we sort of started the day talking about, we are seeing that official development assistance drop. So if we're thinking about blended finance, there's probably more scrutiny on that, because if you are using sort of those precious donor dollars to unlock private capital, you better be doing it right and better be able to prove it's having an impact. So I guess that's my question. What are you seeing? Can you give us some tangible examples of sort of the way you've structured things to sort of price in that risk and then buy down some of that risk so you can get those commercial investors?
Yeah, absolutely. I mean, we're just talking backstage about this a little bit, so to give the flavor to the audience here a little bit. All fund managers, and I truly believe this, want to provide decent returns to their investors. Right? All of us. Nobody wants to provide 0% returns or negative returns to their investors, because we're all in this for long term. We know that we're going to come back into the market and raise subsequent fund and so on. So that takes care of the fact that we only want to use blended finance where we absolutely need it, because we all realize that there's just a limited market out there for blended finance, and if we tap into it when not required, the fraternity, including us, might not be able to tap into it at some other point later. So now that said, I think first loss capital is required mostly in circumstances when you're investing in a sector where the proof of concept is either missing or proof of concept is not as well established as, say, some of the other sectors. So to give you a concrete example, so we've got 3 products in our portfolio, so to say. So we do, we do private equity and private debt, but in terms of sectors, we do financial inclusion, we do agri-food value chains, and we're now starting to do access to drinking water. And across these 3 sectors, we've been quite pioneers. So 20 years ago, we started to do financial inclusion when not everybody was doing it. Again, 10, 12 years ago, we started doing agri-food value chain when not everyone was doing it. And we're starting to do access to drinking water now because it's quite pioneer. So every time we launch a new fund, which is, say, in one of these new sectors, we need to use a little bit of first loss capital, hopefully with the idea that we will never eat into that first loss capital and we'll give it back. The idea there is very simple. We want to make sure that other investors feel comfortable with the level of cushion they have and feel that this is a fund where they can invest money. And so for us to be able to close a fund, it's important that we have that layer. The other thing I want to talk about is, we're talking about de-risking a little bit. So I think a lot of de-risking happens not through first loss capital, but also through technical assistance. Technical assistance is another, and we use more of that increasingly in sub-Saharan Africa because, and I'll give you an example. We were working with Kim, and now it's a company that in the agri-food value chain. And one of the things we found out during our due diligence is that chemical fertilizers are becoming expensive and second ruining soil health. So is there a way for us to come in and help them figure out how they can use organic compost, organic fertilizers? So we did a TA engagement with them, and today they're using mostly organic fertilizer. Now, how does that help us? It reduces the ANS risk. Right? It helps give a better picture of the business to other investors who might come in. How does it help them? It helps improve their bottom line in many ways. It helps them. So it's a win-win, right? So technical assistance is another important lever, I think, that is key in these markets if you want to de-risk investments. And the third one is more around, I would say, taking positions early on when not many people are willing to take positions. And you asked about a concrete example. Let me give you a concrete example about Family Bank in Nairobi. So we were actually one of one of the first international lenders into that business. After we came in, we worked with the company on improving their ENS standards. We worked with the company on measuring their impact.
And when you say ENS standards, environmental and social standards, just to make sure we all understand.
Yes. So environmental and social standards on their impact. We helped professionalize the company and actually helped crowd in 3 or 4 other international lenders, including microfinance, in some of the top international microfinance funds. And they're in advanced talks with one DFI right now to raise funding. So that's a great thing for us, right? As an investor, if we see a business grow, that's a solid upside for us. And that's a solid upside for the business as well. So it's a win-win.
Great. Alexia, do you want to jump in?
Yeah, so on your question regarding the challenges, or on how we can bring more capital to the continent. So I would say that we can bring more capital by trying to overcome the challenges. So every year we run a survey and we ask general partners and limited investors in general what are their views and perceptions in terms of the challenges, what are the most important challenges when they invest in Africa. So every year since 2015, when I joined the organization, it's the same answer: political risk and currency risk. And we also tried, we ran another survey in order to find out how the most successful fund managers in Africa navigate these risks. And the result was that they do that through diversification across sectors, diversification across regions, and also it's really important to select a successful fund manager. So if the fund manager has the right skills and expertise, the network, as you mentioned as well, it's very important to have local offices there and to have a local network. So they are successful in terms of navigating currency risk and political risk. So Africa, given the current circumstances and given the fact that in the first half of the year, a lot of currencies in Africa have already depreciated against the US dollar, it's not a situation which is not very, Africa is not very familiar with. It's not, this kind of crises are there, so investors are very familiar with this crisis. And the second thing, I think we should mention the importance of local capital. So, for example, last year we published a survey and we tried to investigate the role of Nigerian pension funds in promoting the private capital industry within the country. And we found out that only 0.29% of their total assets under management have been allocated to private equity, when at the same time they can allocate up to 10%. So there is a lot of potential, but investors should feel familiar with the private investments and with the asset class and all the challenge, and how we can better manage these challenges.
Great. Teddy, I want to come to you because we talked about a few things: technical assistance and political risk. The DFC has technical assistance capabilities, and that is something that OPIC, its predecessor, did not. So we'd love to hear a little bit about how you're thinking through how you use TA and how potentially you use it to make projects investable, or how you use it alongside other investments to make them have a greater impact. And then you offer political risk insurance. And so I'm curious if you see that becoming a bigger part of the portfolio in this time. And I might also ask you to talk to that sort of currency risk question, because I do think that is a very live issue. And is that something DFC is going to absorb that? Do you have to hedge against it in some ways? Can you play a role in helping protect against that currency fluctuation?
Great, thank you very much. And quite some sound points from Alexia and Kapil, so I'll build on some of those as well. As you say, DFC, well, we were instituted in 2020 via the Build Act. We added 2 more products in our financing toolbox, and that is technical assistance and equity. We used to have political risk insurance, and we continue to offer that as well. And of course, debt has been our mainstay. Now, speaking on the political risk insurance aspect, we're seeing a lot more demand for it, especially as DFC, while we shifted from being OP to DFC, we came with a strong mandate to really focus on the low income and low middle income countries. And so some of these risks that everyone is voicing, we had to find a way to sort of mitigate them so that we also ourselves, the DFC capital, can flow into that and also catalyze some more funding. So we've been really on the trail, drumming up sort of interest in our political risk insurance aspect, where we cover any financial losses due to any political activity, current terrorism, acts of violence, and also we cover against currency and convertibility. So if you're in a country where you're unable to sort of get hard currency to pay back a loan, we can cover against that. For our TA2, normally we'd use this to sort of remove any hurdles that are blocking potential investment from DFC or any other funders interested in the project. So it's for now limited to a particular project that has already received interest from DFC or other investors. And this could be, for example, if the environmental side impact assessment is not to international standard, we could, for example, fund that so that it's upgraded and therefore makes it easier for other investors to put their money into it. In addition, once we have invested, like in last year, we invested in a company in Rwanda called Chansen. They provide educational loans to students in university, and then they get paid back based on an income share agreement with the students. We gave them post-investment TA for them to sort of improve on their credit scoring, and also just be able to service even more students and expand to the different countries. So we can use our technical assistance to enable a business or a company that we have invested in to be more successful in its endeavors. Then one thing I'd like to highlight as well is very good point from Alexia regarding catalyzing local capital, because when we are talking about how do we bring in more capital, the question also should be, where is this capital coming from, right? And therefore, I believe, in fact, some of these challenges we are mentioning, which include political risk and currency, and in forex risk, if there is a local, they are definitely going to perceive those tourists as being, their perception for those tourists is lower than a foreign investor. So it's very critical that we focus on this segment of investors, and beyond pension funds. I mean, pension funds are big, 24 trillion globally. Beyond that, there's also remittances that come back to the continent of Africa. 2021 alone, that was about 50 billion. The question is, where is this money going to? Can we actually provide tools, and can we actually create vehicles where this money will also go into productive uses, investments into VC, PE, young companies, etc.? Because those individuals who are sending money back home actually will send it anyways. They don't care whether there is a coup, whether there is, the currency is deteriorating, etc., because that's home for them. And this has just kept growing even through COVID. So how can we tap into some of these other alternative sources of capital for us to be able to achieve maximum impact?
Great. Paul, I want to come to you quickly. We don't have too much time left, so I want to come to you, and then maybe we'll do just like a flash round at the end, coming back to everyone. But Paul, I'm curious how you, from your sort of perch at OECD, look at sort of the landscape and some of these sort of tools that we've discussed, and where you think they should be used, right? So we could talk about sectors. You talked about water, right? So you may need more de-risking in drinking water because there's not a huge, than you might need in that financial inclusion work, which now has a 20-year track record. So I'm curious what you think, Paul, in terms of where some of this money can be best spent, and how that can be effectively sort of tracked.
Yeah, no, thanks. And I mean, agree with all the other panelists. We need more in the social sectors, a lot more in the water. And I mean, the GSSS bonds that I spoke about are sort of a good tool to sort of look at things like, we saw a transaction in Kenya with Acorn that was for student accommodation, which was the GSSS bond. So big scale, monitoring the impact, and the building hit many green compliance criteria. So there needs to be more effort in terms of bringing in the private sector into these what sometimes might be PPP-like projects. So understanding the private sector needs, but also for DFIs and DFIs to take more risk and build local capital markets, which addresses the foreign exchange conundrum. So helping to sort of have more pools of capital at the local level in local currency to match the flows of the financing with the revenue. So there's not that mismatch. Focusing really hard on critical sectors and countries. So LDCs that don't see much mobilizing, social sectors, education, healthcare, not saying that this should be privatized, but looking for the big ticket infrastructure parts of those sectors where you can bring and mobilize additional funds into them and have the private sector take on some of the risk and the financing of those.
Great. So we have about 2 minutes left, so we're going to do a rapid round where each of you gets 30 seconds. So we'll see if we can do that. But two quick things. One, I think maybe if there's sort of one takeaway, what do we need to see to bring more capital to countries on the continent? And I think one of the things that I think is interesting is sort of the diversity of tools, right? So with these GSS bonds, that's like large scale, what some might call like a more simple tool that commercial capital markets understand versus a fund you design might be a more bespoke instrument. So maybe as you're talking about looking ahead, thinking about how do we put the right tool to solve the right challenge, I think is an interesting thing to look at moving forward. So Kapil, do you want to take this up?
I think that's a tough one, right? Because that's something that it's a work in progress, let's just say, because it depends on the economy, it depends on the timing, it depends on the sector you're going in. But I think if I have to step away from all of this conversation, I think what absolutely needs to happen is that the teams need to be on the ground when you're investing in a market in Africa. And the teams need to take the due diligence process very seriously, because you cannot just go with, say, hey, this is a risky country and we can't invest. So I think tools are important to match, but what is more important is to make sure that that you have local presence and that you are using bespoke tools for the countries and the sectors that you are investing in.
Great. Alexia?
Yeah, I agree. I think we need local presence, expertise in terms of sectors and regions, so the investors should be familiar with the countries they're investing in or the sectors they're investing in. And also, I think personally, when it comes to Africa, it's not only about financial returns, it's about the impact that you are creating for the people there. So, and one of the most important value creation drivers for investors in Africa is when they create impact, job creation, they apply the ESG policies in order to drive impact. So this is a very important value creation driver.
Yeah. Teddy?
Thanks, and I think I would like to reiterate the aspect about having local teams. I also like to reiterate that we need to also catalyze other forms of capital. I like the session earlier about DFI transparency, because another element needs to be sort of coordination and knowledge sharing. What have you learned so far? What's working? What's not working? How can we support further? How can we support our investments further? And then finally, I would say it's just supporting enablers. So there's many advisory firms that are enabling entrepreneurs to be able to get to be a point where they're investor ready, or like incubators, or maybe training programs that enable managers to sort of perform better and reduce even the execution risk in these investments. Feasibility studies, any element that goes towards project prep, or even just getting an entrepreneur or a project to a point where it's now a yes for an investor. I think we need a lot more support in that regard.
Great. Paul, do you have a final thought?
Yeah, I think we've got a massive opportunity in Africa. Young, dynamic, lots of technology, innovations. It's future in terms of growth. We need to communicate that. We think investors misprice the risk and the opportunity. So we need to attract international investors. We need to look at the ratings of Africa, and we need to bring in sort of thinking around the SDGs. We need to think about the risk, return, and impact. And every country is specific, and venture capital is going to be a critical piece in driving innovation. So there's not a piece in the capital structure that we should identify, but for the big needs, and as it is simple, as you said, GSSS bonds can attract at scale, and there's innovation going there in terms of sustainability-linked bonds. Those are some of the sort of areas that we'll be able to mobilize and fill that massive gap that's grown, unfortunately, since COVID. So lots of further thinking and a role for, I think, these types of discussions in driving policy change. Thank you.
Great. Well, thank you all so much. This has been a great discussion. I'm sure we could have kept it going a lot longer, but my timer here is blinking and telling me that we are out of time. So thank you so much for joining us.